Good evening, everyone, and a very, very warm welcome. My name is Varun Sanan. I look after West 1 for Edelweiss. I'm glad all of you could make time and come in today. Welcome to Edelweiss Connect. Edelweiss Connect is a platform where we showcase our investment capabilities. We also showcase stuff that comes out of the Edelweiss table from time to time. It's also a place where you get to interact with our top management, and we get to take feedback from you on the stuff that we've been doing and stuff that we should be doing going ahead. We've got a big agenda, a packed one today, and let's get rolling. There are 3 panels that we're going to be conducting today. Very crisp, very, to the point, and stuff that you will find very interesting. I think let's kick this off with something that's, at everyone's point right now, which is factor investing. And if you've looked at Edelweiss, we've been doing factor investing for a significant period of time. In fact, 15 years plus looking at factor funds through our various strategies. But I think now we've taken it to another level. And let me start the first panel on factor investing by inviting Niranjan Awasthi, who looks after the product and marketing for Edelweiss, Bharat Lahoti and Bhavesh, who are the co-heads in terms of the factor investment team. And let's start this off. Good evening, guys. I think let me hand you your mics. So Bharat, let me start with you. We've reached that point in time where Edelweiss has now become quite meaningful. And we're managing about 140,000 crores of assets. We've just launched a very successful fund on factors. In fact, all of you would be happy to know we've closed out our new fund offering on the Edelweiss Business Cycle Fund, where we've managed to collect over 1,800 crores. This is a fund that will actively look at factors. And I think it's important to understand some of these factors. Now, Bharat, factors are gaining a lot of popularity in India. Can you explain what the various factors are and how do we figure them out?
Great. Good evening, everyone. Factor-based investing, if you want to understand, one has to understand what are factors. If you look at it, specifically factors, if you mean it, what are the drivers of returns? When we look at stock returns, why does stock performance happen? When we ask questions, we get answered, the stock has great growth, the stock was valued very cheaply, or the stock has high quality. These are broad answers what you get whenever a stock performance happens. These are what you call the drivers of stock returns, and consequently these are factors. And when you build portfolio along with those characteristics in portfolio, then you get a factor-based investing. If you look at it, factor-based investing is not new. From a simplistic point of view, Nifty index, Sensex index is a factor. Just to give you, this is a company composed of top 50 companies of India, which is a factor where you talk about how do I play India growth story. If I want to play India growth story, you buy actually the top companies of India, which is Nifty. That is what you are saying. You are going to get drivers of India growth story through Nifty index.
So you're saying size is the factor there?
Size becomes a factor for you. This is a size factor to you. Alternatively, if you look at it, you know long run, small cap does very well. If you buy small cap funds, actually in a long run or 10 or 15 years, small caps does well, but as compared to large caps. So size becomes a factor which is a driving force for returns. Similarly, if you look at it, growth stocks, when we pick up at companies, when we discuss companies, people talk about these companies growing at 20% CAGR, 30% CAGR, and when you look at some of these companies, especially companies where the earnings growth trajectory is very high, like Titans of the world, and those are names. Bajaj Finance has been growing consistently. These companies come in a growth portfolio. And you would see many of these fund houses are actually running growth portfolio. They call themselves growth style oriented funds. So they are actually doing factor-based investing, but in a very different way of speaking it. It's a style of investment, but that's a growth portfolio. Similarly, there are many fund houses which are actually focused more on to value. Look at price to earning, price to book value. They buy many of the PSU stocks, many of the PSE stocks. If you look at it, those companies or those fund houses are value focused. Those are value factors. Obviously, different cycles have different set of companies working around it. Sometimes value does well, sometimes growth does well. So all these factors has a lot of importance in the market. Different cycles gives you different kind of returns.
Fantastic. So basically, there are four factors that we're looking at predominantly: growth, value, quality, and momentum being a factor?
Yes, momentum is one of the important factor. If you look at it, why momentum is interesting, India being an emerging market, most of the time, if you look at it, the market swings widely, whether it's in positive frame of time or negative frame of time. And consequently, momentum as a factor does exceedingly well. Basically, momentum factor is, if the stock is doing well, it will continue to do well, and the momentum pendulum swings in that direction. Similarly, if market is not doing well, the actually pendulum swings the other way around, and the stock starts underperforming. So momentum in Indian context does very well because India is an emerging market to that extent.
So Bhavesh, let me come to you. So we've, grown up listening to bottoms-up stock picking and, fundamental investing and those things where you try and understand a company, etc. How is factor-based investing different?
Yeah, I think, finally, what everyone is interested is in how a stock will give me returns. Now, there are different ways to generate return. There is a traditional way, which we normally call it as fundamental investing. And within that, there are growth style, value style, or you can say quality as a style. Similarly, we have a different way at looking things. A fundamental investor or a fundamental analyst will be deep diving into each and every, you can say, quarterly results, management con calls. So very simple explanation will be, we try to rank stocks on the basis of the different factors which Bharat just mentioned. If a stock is high on growth, for me that higher growth itself is a driver for return. But when it comes to fundamental investing, say for example, if we take example of ITC, someone tells you that ITC is growing at 20%. So a fundamental fund manager or a fundamental analyst will try to deep dive that from where this 20% growth is coming, whether it is their cigarette business, whether it is their hotel business, whether it is their FMCG business, and then they try to project cash flow for each of these, you can say, vectors, whether hotel industry, what is the outlook for next 3 years, next 5 years, cigarette, what will be the taxation implication, if at all government changes that. So you try to predict, you try to assume a lot of things, and then you try to, in a way, calculate a cash flow for next 3 years, 5 years, 7 years, 10 years, and then try to discount that, and then finally you come at the outcome, whether at, say, 500 ITC is cheap or expensive, and accordingly you decide you want to buy or not. So it is a lengthy and, you can say, a complicated process for which you require a lot of dedication, a strong research team, or you can say you have to attend all the management con calls, you have to attend conferences, you have to meet CEO, CFO of that particular company. When it comes to factor-based investing, first, we are not trying to predict future. So that's why we are more relying on data which is already there in public domain. So when we say momentum as a factor, what actually we are trying to look at? Last 3-month return, last 6-month return, last 1-year return. Here, we are saying that if a company is performing for last 6 months, last 1 year, it should perform for next 6 months, next 1 year. So that is the simple momentum factor for you. Similarly, growth as a factor. So ITC is growing at 20% and HUL is growing at 18%. Fundamental fund manager will deep dive into both of them. That 18 of HUL can be better than 20 of ITC because of various reasons. But for me, 20 is higher than 18, so ITC will always get higher importance in my scheme of things compared to HUL. So here we will just rank the growth number and not actually try to, you can say, deep dive that where this growth is coming from. So this is the basic difference between a fundamental investing and a factor-based investing. Fundamental investing is about, you can say, deep diving into the fundamentals and try to find out some, you can say, hidden gems from that. Whereas factor-based investing is more dependent on historical data, and we just assume that historical trend will continue to repeat, and we just follow that repetition of trend in different format, whether it is growth, whether it is value, whether it is momentum.
So there are no presumptions in factor-based investing. We're relying on data that is published, and that data gives us affirmations for the future. Fantastic. Let's get the audience involved a little bit here. Now, we've spoken about a few factors. We've spoken about growth, value, quality, and momentum. I'd normally like to walk across and do a poll, but since I'm sitting, any thoughts on which factor out of these four would be the best performing over a 5-10 year period? Momentum? Anybody for growth? I think we're all momentum investors, and we're all probably right in that regard. If you take a look at data on your screen, momentum is the factor that has performed significantly better across time periods. In fact, growth and value, which a lot of people believe are factors that will do very, very well over a long period of time, haven't shown signs of outperforming momentum. And let's understand this a little more. And let's understand this because a lot of this also changes with different market cycles. And that's where I think, let me get Niranjan in. And Niranjan, can you explain how it works through different market cycles? What are the factors that will do well in which market cycle?
Right. Thanks, Varun, and thanks everyone for being here. So let me use a cricketing analogy while we are going through Olympics, but cricket never dies in India. So let me use that. So if you look at various factors, let's talk about growth. Growth factor is like your aggressive batsman, like a Sehwag, right? It does well when the conditions are good. Ball is coming easily on the bat, and he does very well. Growth as a factor usually has done well in years like, 20 markets were doing well, economy was doing well. So, and, companies are growing fast. As Bharat mentioned, growth as a factor is basically companies which are growing faster than their peers in the sector. So growth is like that Sehwag, Yeah. Coming to value. Value is a very interesting factor. We all are proponent of value, but in India it has not worked actually. But value is like that middle order batsman, say like Dhoni, when the top line collapses, he comes in and plays for India. And when he plays, well, we know he will win the match for us. So value is like that. And in India, it's only last 2-3 years where we have seen value doing well. Generally, value does well when, we are going through tough market conditions. It also does well when economy has just started recovering. It does well, interest rates are rising. And we have seen these kind of conditions between 2021, 22, when we were just recovering, interest rates were rising, and value did well. But, as we have seen, it has done well maybe in only last 2 years over the last 12 years. Coming to quality. Now, quality is like a more consistent factor we have seen in India. He's like a Dravid, more dependable. Fundamentally very sound. So quality we know are very fundamentally strong companies. And India, if you see 2013 to 2017, quality has done well couple of years. 2021 was a good year for quality and so on. So quality basically again does well when economy is doing well. It also does well when, economy is doing sideways or tough conditions.
There's a turmoil in the economy,
yes,
like 2013,
yes.
where
Absolutely.
we saw taper tantrum,
yes.
and people wanted to, hide behind quality companies.
Right.
There, 2015
Absolutely.
was an example of that.
Yes, yes. Now coming to momentum. So momentum is a very interesting factor. We call it, in cricketing analogy, it is not one player. It is a player who is in form. And when any player is in form, basically he has a skill set which matches Kohli. His aggression matches Sehwag. Yeah. And his acumen maybe probably matches Dhoni as well. Because he's in form, he's hitting the ball very well. Now momentum is an interesting factor. It picks up value stocks when they are doing well. It picks up, quality stocks when they are doing well. And picks up growth stocks when they are doing well. It encompasses all. It doesn't have its own style. His style is only to hit the ball and be in form. And that's the reason, if you see last 12 years, 11 out of 12 years, momentum as a factor has done well in India. and how it has done well, we have just seen.
Yeah.
The returns since 2010 is almost 20x versus other factors, be it growth, quality, or value, which are somewhere between 8x to 10x.
Yeah, we in fact saw that chart
Absolutely.
a while back, how momentum's actually done well. In fact, what that makes me understand is that momentum shifts from one factor to another.
Absolutely.
If value is doing well, momentum will shift into value companies. If quality is doing well, it'll shift into quality companies, right, or move into growth whenever.
Like 2020 was a great example. It was a tough year. And actually, if you see the chart on the next slide, momentum as a factor did really well in that year as well. We have seen markets changing the cycles, sector rotation, because it had quality stocks when quality did well during the turmoil, and later on it switched to maybe value stocks as well as growth stocks. So it did really well. So momentum is basically picking informed players. The fundamental reason why momentum does well lies into the behaviors of our investors. We have typically a herd mentality, and we chase performance. And that's universal, which will never change. And that's the reason momentum will and has done well for many, many years and will continue, because behaviors will never change.
In fact, quite interestingly, we saw data from 2008, and all of you would remember how markets corrected so deeply in 2008. That was a year where we had one of our largest sell-offs in recent history. And momentum shifted gears. Momentum was earlier with FMCG companies, because when markets are falling, there's also something called negative momentum.
Absolutely.
So, Bharat, can you explain negative momentum a little bit?
So yes, if you look at it, momentum works both ways. Whenever the markets are tanking, when you look at ranking of stocks, and when you rank stocks based on performance, especially on a 3 months, 6 months, 12 months, the stock which have delivered the least returns in a falling market will be the worst momentum stock. While the stock which have fallen less in the momentum falling market are the best momentum stock. Those stocks actually do very well. So in 2008, actually FMCG or quality companies were doing exceedingly well. Negative momentum actually helped out to wade out some of the high beta stocks and take some of the advantage of the quality or defensive names in the portfolio.
My memory fades me, but I think Hindustan Lever was positive that year.
Yes.
Yeah.
If you look at it from 2004 to 2008, I think many of these FMCG analysts were pretty much bored about the working which was supposed there, because at that point of time, only thing which was working was infra. So most of the fundamental analysts which were tracking FMCG, HUL was extremely bored. In 2008, that is the time they were getting a lot of queries, a lot of answers to be done, whether the HUL or some of these consumer stocks were doing well. So factors have different times and horizons, different cycles, which works from them.
So let me go to Bhavesh now. Bhavesh, I travel a lot. I'm a sales guy, and I meet a lot of clients and distributors. One thing I keep hearing is that momentum probably works in India. And India is not a mature market, and that is why momentum's working in India, and that is why momentum will do well in India. Is this a myth, or is this correct?
See, I think there are multiple myths associated with momentum. One obviously is it is only in, you can say, Indian market, or it is only some, you can say, mispricing, which we are able to, you can say, utilize when we look at momentum. But when you look at global data, momentum is doing, you can say, if you'll see, in US, it is very difficult to beat the benchmark. But when you look at data, the simple MSCI momentum index of US is outperforming US consistently. And this data is not only for last 10 years, in fact, for last 30 years. So if in 30 years in a developed market like US, so from 1994 to 2024, momentum is continuously outperforming. It is not only in US, you look at Japan, you look at Europe. And for that matter, in India also, now there are momentum-based index, you can say generated by NSE on mid-cap momentum, large-cap momentum. Look at their data. We have data for almost last 19 years over there from 2005 onwards. And for 19 years, the trend has not changed in India also. So though one may think that momentum is only a bull market phenomena or only India specific, but that is not the truth. I think when you look at data, it has been the case where momentum is outperforming active fund, not only in India, in developed market, in other emerging market. And it is not only into mid cap or small cap, the case is true for even large cap investment also. Another myth is momentum is only a bull market product, and normally in bear market, momentum should fizzle out. But we have seen correction of 2008, 2011. In fact, when we were doing roadshow for our business cycle fund, one interesting data we found out that in last 12 years, there are more than 9 times where markets have tanked by 10% plus. Because normally at lifetime high, people are generally worried about what if tomorrow there is a correction in market. So we have seen 9-10% fall in last 12 years. And in that 9-10% fall of momentum compared to their respective benchmark is plus or minus 2%. So neither a big disaster, neither a great outperformance. So in falling market, all are falling equal. Plus or minus 2% is the difference. But in rising market, in recovery market, we have seen an outperformance of 8 to 10%. So now that falling market will be maybe 20% or 25% of the time. So in 10 years, if there are 2 or 3 correction where you are falling in line with what the benchmark is correcting, but in remaining 7 years, if you are able to generate 8 to 10% outperformance, that is how your CAGR for 10 years, 15 years across geographies looks exceptionally well. So it is purely a myth that it is only an India-specific phenomena or only a bull market phenomena.
Bharat, let me come to you. Now, we've been doing a lot of work on factors. We've also been, trying to understand different factors, how they interact with each other, how growth interacts with quality or how quality interacts with momentum. And we've very successfully closed out an NFO on multi-factors. Can you explain the power of multi-factors versus a single factor fund?
Yeah, you're right. If you look at it, single factors also deliver a great set of returns. It's not that, because what you are trying to find the drivers of returns, value, quality. And when you look on a long dated performance, low vol, momentum, quality, value, all deliver good set of return as compared to index. But when you look at in terms of risk, actually many of these risk parameters, especially standard deviation, when you look at it, the returns risk are pretty much high. Actually, you can generate more returns by reducing those risks also. So when you use a multi-factor model, when you combine some of these factors, actually you can reduce risk and enhance returns to that extent. So what we have done is, if you look at some of the returns of the single factor, maybe low vol, you would see actually returns are subdued somewhere around 15-16%, comparable to index returns. The risk is lower, returns are similar. So this is a single factor low vol index, but when you combine low vol with momentum, actually you enhance the returns and you don't enhance so much of risk to that extent. So if you look at it, the returns on a 10-year gets enhanced to 23%, while the risk actually is somewhere closer to 15%. So you have kept the risk same, but you have enhanced the returns. So when you combine 2 factors, 3 factors, 4 factors, the consistency improves, the risk reduces, the return profile improves, and the risk-return framework becomes very important.
And can advisors actually choose different factor combinations through different market cycles as well?
Yes, obviously different market cycles works different for different factors. As we discussed it out, 2020 was a great year for quality. 2021 was a great year for growth. 2022 was a great year for value. So advisor can select all these factors, or if somebody doesn't want to do that factor timing, they can come with multi-factor models, and that can help you out to solve the problem.
In fact, the data on the screen is pretty interesting, because if you take a look at what we have on screen is the fact that markets are probably at an all-time high, and you would probably want to dial down on the risk a little bit. So if you build 2 factors, say you want momentum in the portfolio and you build quality with it or low vol with it, you are reducing your standard deviation, and it's working wonderfully for you. My last question before I close this out to Niranjan is, Niranjan, very quickly, just to sum it up in about 2 minutes, what's the growth of factor funds in India, and where do we see this moving forward?
Right. While we all discussed on factor investing has 2 babies. One is active, one is passive. And both are growing in India. As far as passive is concerned, we have moved away from just Nifty 50 market cap based indices and to multi-factor indices, smart beta indices based on quality, momentum, or a combination. Just to give you some data, alpha low vol, and we saw the data, the best risk adjusted returns come from combining low vol and momentum. Alpha low vol index in the large cap space And a lot of people know that building or generating alpha in large cap is tough. This index in last 5 years has generated almost 4% alpha versus Nifty 50 and Nifty 100. The returns are 20.5 versus index, which is 16.5. The best performing large cap, active large cap fund is 19.5. So smart beta indices, multi-factor indices are giving a tough time to, plain vanilla market cap based indices and also some of the active funds. As far as growth is concerned, in the last, say, 5 years, if you see, the AUM has grown from 185 crore to 25,000 crores. This has been the fastest category within passives to grow. And today, if you see the 5th largest passive fund or index fund, if you see, it is based on a momentum index, which is smart beta. So this is moving very fast. Another data point, there is a myth that only direct investors, DIY investors are going. Actually, if you look at index fund, because it has regular and direct option, regular option commands 60% of the AUM. And within direct also, and we've seen that data, 20% is coming from advisors, RIAs. So almost 80% of this AUM is coming through advisory. And I think so it is gaining a lot of pace, and it will grow multifold from here.
I think since advisors have picked it up, now is when the game will kick into the next gear, and we will see a boom in factor funds. With that, thank you all very much. And let me move now to our next panel. And to moderate our next panel, we've got our head of sales, Deepak Jain.
Interesting. Momentum mein momentum hai. So now we call upon stage the team that actually looks at data from a futuristic perspective. They deep dive into some of the factors and use their wisdom of 25, 30 years to predict which sectors and stocks perhaps will outperform. So happy to welcome Trideep Bhattacharya, Head Equities at Edelweiss Long Only team. Trideep, I would also request you to invite your team, your colleague to stage and also introduce him to the world of partners in Mumbai. He's a known commodity amongst us, but not necessarily amongst partners.
I wouldn't call him a commodity. He was certainly tough to hire. But I think as some of the factors will become common, get straightened out, we need to deep dive our insight onto fundamental research. And that's something that we have done at Edelweiss by strengthening our research capabilities. And to take it further, we've got Anirudh, who has joined us as head of research. And hopefully, with regards to intellectual property in and around research, he will help us taking this even further. So Anirudh, please join me. He has over 20 years of experience with regards to multiple sectors. Consumption, financials, he has it all. So actually, I am useless here. You can ask him all the questions.
So just to give you some background to this, we at Edelweiss have two distinct equity teams. One you just met, the one which manages factor-based investment, and the other is traditional investment headed by Trideep. We've also separated the research and dealing functions last year, and Anirudh will head our research function. So welcome on stage, Anirudh.
Thank you.
Let's start. So before I move on to sectors, economy, etc., let's really address something which is very contextual. Modi 3.0 first budget versus the first two budgets that you have seen. What exactly do you see in terms of continuity and change?
I think the big difference between Modi 3.0 and Modi 2.0 and 1.0 is the politics part. And I can't state in media, but here I can be straight about this. The fact of the matter is that of the 50 basis points of dividend that RBI gave, almost half of it went to Andhra Pradesh and Bihar. That tells you the element of politics in what he's trying to do. And if you ask me, I think Honorable Finance Minister did a fantastic job at balancing politics, economy, and markets all in one go. And I think the market that day was volatile, but over time, with very close to being all-time high, has given a thumbs up to that. So, so that's the element of politics. And that is what is the difference as we go out, as we have 3 state elections coming about. We have seen some measures which you would call, more populist than earlier, whereas Modi 2.0 and Modi 1.0 was all about just economy and markets. And, we went really all guns blazing at capex and stuff like that. Here, it'll have to be balanced a little bit. So that's the first point, that balancing the politics element. What was interesting is that, in this budget, basically, the economics part, which is the budget allocated towards capex, and at the same time defense, and all that they talked about in Modi 2.0 was also maintained at the similar pace. Only thing is, it was not new on the budget day. It was announced in the interim budget, and it was pretty much the same. So, 11 lakh crores, and we have all seen the data. That's a thumbs up with regards to direction. The third part, which is the markets part. Now, this is where, again, there was a balancing act. There is clearly, and Anirudh can vouch for that, competition between bank deposits and money getting into funds. And that's kind of evident across the language in multiple forums that we come across. So what we saw is some of the taxation, which we saw a little bit of kind of, capital gains tax increasing for equities, STT increasing for F&O, and today there was some other measure which has sort of come about. So net-net, if you look at budget in the context of the broader theme, what the government is trying to do is trying to kill the arbitrage across market classes, creating a rational tax structure, and hence over a period of time will create asset classes where investors come for the love of the asset class rather than trying to manage the tax arbitrage across funds. So all in all, answer to your question, politics, economy, and markets balanced very well by one of the finance ministers.
So let me just pick up on the same point that you mentioned, politics and economics. Though we knew from past experience that the government has been very tight about fiscal discipline, yet because of politics, because of a so-called fractured mandate, there was a lot of expectation on loosening the purse string, especially on rural and semi-urban spending. And this question is to both of you. How do you see that in the context of overall scheme of things and for next couple of years?
Why don't you start with the fiscal math? Yeah.
So, yeah, especially given the fact that there was a big largesse from the RBI. Did we see any sugar rush in terms of cash doleouts or creation of income transfer schemes, which will boost the near-term demand? Clearly, the answer is no. What we have seen instead is a very conservative continuance of a very conservative macroeconomic policy framework by the finance minister, and which holds well in terms of how the overall interest, how we will be positioned in this interest rate cycle. Now, this is important because especially given the fact that we are probably on the cusp of a global monetary accommodation, creating these artificial boosters, demand boosters at this point in time can overheat the economy and create imbalances, which we have seen in the past. Importantly, what the finance minister has done is that instead of giving this high sugar dole-outs, we have seen sugar-free options in terms of tinkering a bit in terms of the tax base for the new tax regime, and also creation of more structural medium-term employment generation schemes. Now, this probably, if you look at the math, it's almost come at an outlay of 10,000 crores, and this needs to be compared. In the scheme of things whereby the incremental transfers to the states is almost 45,000 crores, and 30,000 crores is the incremental transfer to PMAY. So it's an experiment which the government is doing to lubricate the hiring process and create employment, and thereby create structural tailwinds for the demand drivers. And that probably, I think, is a more sustainable way to go forward. So all in all, I think it has been a pretty good, sound balancing act by the government.
So interesting the way you put sugar and sugar-free. Trideep, you wanted to make a point?
I just wanted to kind of add on 2 points. The fiscal deficit with a 4 handle to it is a great news for markets. Ultimately, it is going to reduce the cost of capital, which is what we want from an equity market standpoint. It will make over time, along with the bond inflows that we are seeing, is great news from a fiscal consolidation standpoint, and directionally, we are headed in the right direction. Of course, the RBI dividend helped that, and hence, a lot of things fell in place. Life may not be that simple in the next budget, though.
So from a sugar and sugar-free context and the politics part that you mentioned, and 2 states, which one can argue actually need some assistance, but the assistance was provided more in infra and perhaps growth accretive assets or growth accretive spends. So how do you see this? It's not necessarily a dole out. Will you call it a sugar or sugar-free investments or expenditure?
No, it's more structural, and it's certainly, I mean, we've not had any, the sugar rush part, I mean, clearly over the years, the government has been avoiding that. And even if you see in this particular, if you put the capex of the center as well as the PSUs together, at almost 3.5% of the GDP, it's pretty strong. 16-17% growth. That's pretty strong growth that's happening. And I think given the fact that we are already having a good monsoon, the MSPs have risen. There is a case for the organic consumption cycle to turn around. The Nielsen data corroborates this particular fact. If you look at the commentary from most of the consumer companies, that is kind of highlighting it. I suppose once the interest rate cycle begins to turn down, the organic consumer sentiment as well as the cycle will pick up.
So we'll leave the more interesting part of the budget for next session of Rashesh and Radhika. Perhaps they will help us decipher the policies. Let me throw some easy questions over to you, which is just predicting which are the 5 sectors you think are going to do better post this budget. A relatively easier task, Trideep.
That we will know in a year's time, assuming they do well or not so well. So, I think on net balance in Modi 3.0, the sector leadership is unlikely to change. It's the first conclusion I would throw at you. I think if you look at the drivers of the economy, we are, as we sort of portray, moving towards Viksit Bharat, driver being manufacturing over consumption, and that is going to continue to remain the same. Which end of manufacturing still has the valuation support and has the earnings growth is basically the quiz that we have to solve for ourselves as investors. And that's the challenging part as markets keep going up. But nevertheless, if you still ask me, the first area where I think earnings are likely to be resilient would be CapEx. 2 years ago, it used to be short cycle CapEx projects, which used to be kind of working capital led. Today, it is more power led. Today, it is more investment in railways. But the direction is more manufacturing over consumption. So that's the first area that I would talk about. Second is, of course, the very popular topic of late, topic of multiple fundraisers, defense. It continues to be the area that attracts a lot of attention. And fundamentally, the companies that are operating in this have their order books full for the next 10 years. Very rarely in my 25 years of career in markets have I come across a sector where the next 10-year order book is full. But that is what the situation is, and that is why some of the valuations are what they are in the sector that you see. So we have to kind of deep dive, be more selective in while picking stocks, but that's the second area that I would highlight. The third area that I would talk about, which is unique to India, relative to the region and also to globe, is real estate. This will be even better, particularly in falling interest rate regime, which he was hinting at, which might be there in 12 months' time. Now, while China is going through its own motion, United States dealing with high rates, here we have inventories still at 10-year lows. It used to be 12-year lows, now it has 10-year lows. So the real estate as a sector is, in my opinion, in the middle of a 3 to 5 year upturn, We have seen stocks doubled, but if you look at past historical real estate cycles, they have further more room to go. The two new sectors that I can throw at you where we are working on, we have added position over the last 3 to 6 months. One has been IT, where we have talked about earlier as a dark horse of the year. We launched a technology fund as well. And so the subsequent results actually in the last quarter show that earnings are bouncing around the bottom. The outlook is gradually changing, and it's that twilight zone where it has not yet got the momentum, and good time to be early in there. So that's one. The second is select consumption. Now, this is one spot which probably in Modi 3.0 will probably play a bigger role than what we saw in Modi 2.0, which was very capex in one direction. Here, selective consumption, consumer discretionary, and also some consumer staples are a good place to be. So in this way, hopefully I have described the areas that we, based on our thorough research, find where earnings are likely to be resilient, which is 60% of the job done. The 40% of the job done, which is probably why the fees is to figure out which stocks in those sectors are still cheap enough where money can be made, as opposed to generally the sectors in itself, which we leave it for the portfolios to be.
So given the context of upcoming or proposed accommodation by central banks, this may start 6 months from now, 3 months from now. Also the valuation multiples you spoke about, Trideep, and 10 to 15 years of order book. Given the entire context, how do you really make some sense or give some sense to our partners with regards to valuations of some of these companies in PSU, defense, capital goods, with regards to, let's say, a 10-year DCF kind of a method? Even in that, with a lower discounting at 5-6%, does it make sense?
So let me answer this question in a different way. That if you look at where we are coming from capex, what is the weightage of industrials in the index? I thought this is one of the very popular index. 8%. Now, overall, if you look at, let's say, any of the developed markets, whether you look at, United States, Europe, manufacturing is a lot bigger part of their index than where we are. Why did I pick that number? The reason I picked that number is we've been undercooked in this area for a good 40, 50 years. And you could have seen that in the airports, in various physical infrastructure, which is what is in the process of changing. Still, we had the airport roof collapse, but despite that, the airport infrastructure has gone significantly better. The point is, while China manufactures 10 years in advance, we are probably 10 to 15 years behind. And that's the reason, that's the problem we are facing in power sector. Today, the supply-demand gap is outpaced by almost 5 to 6 percentage points. We would be back to the load shedding days, trust me guys, sooner than later. So that is the extent of investment that is being needed. And so much so that for all the noise of ESG and ESG fans, good old thermal-based power stations, coal mines are finally kind of put on block to see if they can be kind of put in action to get cracking. So that's the extent of where we are. I recall at some point ITC and L&T, these two stocks were really forgotten given ESG concerns, but then they made a roaring comeback. My suspicion is good old thermal power, good old power stocks, which so far have been quoting on 7-8% dividend yield, will finally make their day over a period of time. To cut a long story short, we are hugely underinvested in infrastructure. We think even if we make 5 to 10 years of underinvestment, of supernormal investment, we will just get back to normal. So if you factor that properly in the numbers, I would say that we still have decent upside in some of these names.
So you spoke about underinvestment from an economy perspective, but over the last few years, I believe that some of the underinvestment from portfolio perspective, some of the quality names, the erstwhile quality names like private sector banks, FMCG, etc., are perhaps under-owned or perhaps a less attractive commodity at this point in time. Do you see a contrarian play opportunity or a value play, a factor that sometimes does really well?
Yeah, in fact, apart from the themes that are already doing well, the couple of themes that we are evaluating is FMCG and discretionary consumption, mainly in the spaces of electricals, durables, building materials. this real estate cycle has started sometime in 2021, so we're almost 3 years into it. Most of the projects which would have started being built up, we will start seeing the delivery of that. And the late stage building materials and household appliances, the demand will start kicking in. In fact, as we speak, so that along with the replacement cycle kicking in, will start showing up in the results of the companies. This particular season, we are already seeing that through the results of consumer durables. Whirlpool, after a very long period of time, has delivered some really stellar numbers. Similarly, Havells. So that the entire pack should do well. Apart from this, chemicals as a space probably is another space that we are evaluating. Select names in that within the agro as well as specialty chemicals. Affordable housing will remain in play given the thrust of the government. So that there will be some names over there that we are kind of hunting for. And non-lending financials. That's another place probably where we think there would be opportunities. They've been kind of out of favor since long. So those are the sectors and spaces that we are looking at very closely.
So one last question to both of you. Maybe Trideep, you can answer. Private sector banks had done very well in last 20 odd years, but last 2 years the numbers have improved. I mean, from a valuation matrix, other metrics that you follow, and yet the stocks have not gone anywhere. So something fundamentally must have changed. Has it changed, and what has changed, and how do you see that playing out in next 2 to 3 years?
So if I actually from COVID, financials have overall done quite well. But financials today is far more heterogeneous sector than what it used to be 10 years ago. 10 years ago, people who have been investing, all you could do is banks. It was a boring, monolithic sector. Today, you have insurance, you have capital markets place, you have stock markets, you have brokers, wealth management guys, so a whole bunch of players who are kind of, far more different from monolithic banks. So money has moved out of banks into other areas as well. But the weightage of financials in the broader markets have actually kind of, been particularly on the higher side. And that's what I would say, that net money has gone into financials, not necessarily the traditional banks, but into far more different players than what it used to be. You want to add?
Yeah, just to add to that one point, and probably this is more technical in nature, is that most of these private sector banks were defensive in nature. Given the fact that in most bulk of last decade, we were struggling, most of parts of the economy were struggling. Flows moved to the quality names in whichever sector. The broad basing of the economic growth has ensured that the flows have kind of started also getting broad based. And hence, traditionally, though they are doing well operationally, within financials also, the private sector banks have been underperforming the other parts of banking as well as financial segments for that reason.
Great. We'll take some questions at the end of the session. So this is a pause. So thank you, gentlemen, for your time. Really appreciate.
Thank you.
Round of applause. So let me start the final and the main session. For that, I'll invite our MD and Chairman, CEO Radhika Gupta. Please come on stage.
Good evening, all of you, and it is incredible to see all of you here in such large numbers, right to the back of the hall. And before I do invite Rashesh, I think on behalf of all of us at Edelweiss Mutual Fund, just a huge thank you for the incredible support that you've given this business over the last 6-7 years. The claps are really not for us, they are for you. So thank you very, very much. I think in the last 2 panels, the good news is much of the hard work has been done. So I don't have to ask Rashesh the prickly questions about rating the budget 8 or 9 or 10. And I don't have to ask him what he thinks on capital gains because Trideep fell into that trap. But I'm really excited to have this conversation. And I think we will have a interesting long-term conversation. And Rashesh, we have the last panel before dinner, so we have the job of being both informative and entertaining. I've moderated with you many times, so I'm sure we'll do both. So with no further ado, our group chairman, Rashesh Shah. Great.
Hi, everybody. Good evening. And again, Radhika, thank you for having me here. I'm always excited. And over the last few years, I've always realized that meeting employees and partners and customers and investors is what really energizes us, because that is where the real lay of the land is. So I'm very happy to be here. Thank you, all of you. And thank you for having me here.
No. Always a pleasure. And, when I talk to you, I always get very fascinating insights on India. And as I said, a lot of the short term has been spoken about. So I think we can use the next 45 minutes to talk about the long term. But there was an interesting story, Rashesh. You and I were traveling to Bangalore, and I think you travel a tad less than I do. But I remember us walking out of Bangalore airport, and those of you who go to Bangalore, the airport's buzzing outside, right? There are coffee shops, and there are people consuming and spending and all of that. And as we walked out, Rashesh told Deepak and me, he said, Radhika, this is what a $4 trillion economy looks like. And that's where I wanted to start, is as an observer of India, what does a 4 trillion economy mean? When is 10 trillion happening? And, the other thing they say in investing is, with so much buzz about India, there's a belief that this is different. And this is different is a little dangerous in investing. Is it different?
So, the interesting thing about India is everything you say about India is true, and the opposite is also usually true. So it is different, but it is also the same. And I'll explain why. And I think the $4 trillion GDP is a very important, kind of an indicator figure. But obviously, we all know, ultimately, GDP is just a very broad, crude estimate of how we are growing, where we are going, all of that. But to give you a small parallel, the US economy was $4 trillion in 1989. That was the year I graduated from my MBA school. So the whole of US was $4 trillion, which is what India is today. And the other important thing I remember, and maybe very few of you may have seen that, the BSE Sensex at that time was about 800 in 89. This is now 80,000. So having seen what US was, India has become that in terms of size, and almost 100x kind of a growth in the index. I do feel this growth story of India has been going on for quite some time. India was about $100 billion GDP size in 1982. So we went from 182 to 200 in about 1991.
Yep.
We became 400 in about 1998. We became 500 in 2000, became 1 trillion in 2008, became 2 trillion in 2016, and 4 trillion in 2024. For all of us who are slightly more arithmetically inclined, there is a clear geometric progression that is there in this, that every 8 years in US dollar terms, the Indian economy has grown by 100%. We have become 2 times in size since 1982. So almost 42 years, this growth has been going on. And all this is in US dollar. In Indian rupee terms, we have actually doubled every 6 years, which, as all of us know in investing, it's about 12% GDP growth in the...
Which is what the index has also delivered, which is what the large cap equity
which is what the index has also delivered. So the India growth story has been going for more than 40 years. But the interesting thing is, at that time, it was on a small scale.
Yeah.
So it's like an investor who has, maybe 100,000 rupees, and he's investing and making 30% return. But now he's making 30% return on a 100 crore portfolio. Now the game has changed in terms of scale, and what we were speaking in Bangalore, we are still continue to experience the same growth. We will continue to double every 8 years. Maybe 8 will become 8.5. But so I expect in 2032, we should become 8 trillion. In 2035, we should become 10 trillion. The interesting thing is in 2008, India was $1 trillion. Now we will add $4 trillion in the next 8 years.
Yeah.
And that is really the scale. And that 4 trillion means about 2/3 will go into consumption, about 1/3 will go into investment. So that has been amazing about India. For 40 years, almost the broad parameters have been the same.
Yeah.
You know, GDP has grown between, average between 6 to 8%. Inflation has been about 5%, give or take a little bit. Consumption has been 2/3 of the economy. Investment has been 1/3 of the economy. So India has not changed in that sense. But obviously we have changed. What we see out here, what we see in airports, what we see everywhere. Because now this is at scale. So we are now compounding at scale. And we call it in Edelweiss, the golden age of compounding of India has come. And as we see in investors also, the other parallel I give is, Berkshire Hathaway, Warren Buffett, at the age of 60, he was worth $1 billion. In the next 30 years, he was worth $100 billion. So when you compound, and that's a good thing about investing, that you don't get old. You get a chance to compound more. And actually, that is what is happening to India. And actually, that is the opportunity for all of us, that the next 8-10 years, we can participate in this golden age of compounding of India.
So, Rashesh, I'm not going to ask you what can go wrong with the India thesis. It's a common question. But there's an interesting story that I heard, that if you look at two countries, if you look at Thailand and South Korea in the 1970s, effectively they had about the same per capita GDP. Obviously, Korea took on a very different trajectory than Thailand, and Thailand fell into what they call the middle income trap. What do you think India needs to get right so that we don't become Thailand and middle income trap and potentially become South Korea? Something I think about a lot.
So unlike Thailand and others, which were slightly more autocratic, they had coups and all, and there has been a political instability in a lot of these countries, I think countries like India, US, have a very strong ability to correct, to self-correct. And the reason, for about 42 years, we have grown in that because we have had, coalition government, BJP government, Congress government, everything in this 42 years. I think India constantly self-corrects. We rebalance. We move from one side to the other. And that is a good thing, though a lot of that induces some short-term volatility. A new government comes, some old policies are revisited. I remember about 20 years ago, privatization of HPCL, BPCL was big news in 2002. It got backtracked, it came back again, it backtracked. So there is a little bit of flip-flop, constant adjustment, tinkering as we call it, every year, because you are adapting to the realities of the world. You are adapting to the reality of the political mandate that we have. But that creates uncertainty and some amount of volatility, but that also allows you to rebalance all the time. So I think what we need to get right is continue to do this. So except for the emergency period in India, we have constantly rebalanced. Governments have changed, government policies have changed. And, wherever we have swung a little bit on one side, we have come back. And I see the US has been pretty close. I mean, we had, they had 8 years of Clinton, then 8 years of Bush, then 8 years of Obama. Now there is a lot of uncertainty going on again out there. But countries that adjust, that constantly adapt, actually can enjoy this long-term growth as an opportunity. Along with that, what you need is obviously a very entrepreneurial kind of class. So if you look at Thailand and other countries, and I don't know as much about them, but I think the entrepreneurial energy that we have in India is huge, a lot more. And one of the indicators of that is, where are the entrepreneurs there? So in most of the countries you will see, most entrepreneurs are in either 1 or 2 or 3, cities of the country.
Yeah.
So you go to Thailand, you go to even Turkey, everything is Istanbul. There is hardly anything outside of Istanbul. It's the same, entire business community. If you go to US, it's not that.
Yeah.
You will have investors, somebody in Omaha, somebody in Tampa, somebody in Dallas, somebody in Chicago, somebody in LA, somebody in San Francisco. It's very well spread out. It's very few countries have that. So I think India, what we have seen in the last So the other aspect of what is different this time in India, what I see and what energizes all of us a lot is truly entrepreneurship has gone across India. You go to Kanpur, you go to Indore, you go to Varanasi, even if you look at the stock exchange listed companies, there is heterogeneity coming in. The other comparable is the Indian cricket team. If you go back about 30 years ago, all the cricket players were from, either Mumbai, Delhi, Bangalore, Chennai. Last 30 years, all the cricket players come from all over India, happening in sports. I think it's happening in business. I hope it continues to happen in business. We have to lose this hegemony of, Mumbai, Delhi, and maybe I would say Mumbai, Delhi, Bangalore as the real entrepreneurs. Entrepreneurs have to come from all over India. As long as we get that, because the need of India is still there. We are still a $4 trillion as a large country. And as I said, the opposite is also true. We are a small country because it's only $3,000 per capita GDP. So we're very small at a per capita level. We are very large at an economy, So India is both of them. I hope the small gives us the opportunity and the large gives us the scale to invest into infrastructure and all that we've been doing. So I think that is going to be an exciting part of India.
I promised I wouldn't ask about the budget, but I think one of the themes that came out in the budget was the importance of jobs. In fact, many people declared it a jobs budget. How do you see jobs? You see the demographics, you see the young population as someone who employs a lot of people in your role at FICCI as an observer of many industries. How do you see the jobs story today in India? Do you think the budget has, by the way, done enough to address it?
I think it has tried enough, but you are very right. I think jobs is the biggest challenge in India. And it's not just jobs, it's underemployment. It's not unemployment. Actually, in India, a lot of people are underemployed. They are not unemployed. They are not earning enough. Yeah. Somebody is, doing a courier job and just earning to live by. There is no extra that is there. And I call it underemployment because at this size of the economy, we should have that. The problem with jobs is actually across the board, from including simple data on jobs. So I just saw that there is a cabinet committee that has been formed on getting data on jobs. We don't know today how many people are employed in capital markets in India.
Really?
Who has the estimate? Give me an estimate. Whether it's brokers, sub-brokers, MFDs, all of that, we have no estimate of how many people. And it's not just NFD, because an MFD will have 8 people in the office. We have no idea. We have an idea of how much AUM has grown. Can somebody show me data of how many jobs in mutual fund industry have been created in the last 20 years? Why? Why should it only be AUM? It should also be jobs. So RBI, SEBI, IRDA, they should ask the companies that they regulate that tell us how many jobs you are creating, have the data, and the SEBI chairperson should say that this is how mutual fund has created jobs. This is how broking industry has created jobs. This is how wealth management has created jobs. We don't have the data. I mean, we have crude data about 500 million jobs in India, 250 agriculture, 250 non-agriculture.
That's very crude.
All these are very crude, and we have no idea what is growing, what is not growing as a result of government policies, as a result of regulators. If RBI has opened up banking, new small finance banks have come, we should know how many jobs they created. We know how much deposit growth has happened. We know how much credit growth has happened. We have no idea how many jobs got added because we added some 18, 20 small finance banks. I think it was a great move, but we should estimate that. So it starts with that. And I think I've been saying that all the time, that all the regulators, whether it's TRAI, SEBI, RBI, IRDA, they should force their companies. You submit hundreds of uploads to the regulator every day.
I've never submitted my employee count. I've never submitted my number of employees.
You have never submitted your employee count. We know how much our AUM has grown. Yeah. We don't know how much our headcount has grown. Yeah. And the other thing, I feel that we should celebrate creating jobs. As we give award for the largest market cap company or the Entrepreneur of the Year award, we should, if we get the data, then we should say, okay, this company created the most amount of jobs. I mean, I feel proud that in Edelweiss we have created 8,000-9,000 jobs over the years as we have grown. So yeah, we have built market cap, we have built assets, liabilities, all of that, which is all reported every quarter. but we have never been able to speak about the jobs that we create. And I think we need to create that entrepreneurial zeal of not only creating wealth, but also creating jobs.
It's interesting, the media has celebrated unicorns, but it's never celebrated
jobs.
It is a very interesting perspective. You know, Rashesh, Trideep spoke about the opportunity in manufacturing, some of the capex intensive sectors, but there has been this conversation on one day private sector capex will start. I keep saying it's like Karan Arjun, ek din aayega. You know, there is a perspective that government says it's the private sector's job to do that. We are not doing more in the budget. There's a perspective that says, well, you know, entrepreneurs are scared of taking debt because of what has happened in the debt cycle. Has private capex started? Has enough happened? If it hasn't happened, why hasn't it happened?
So I think, as with everything else, this is also a fairly, complex issue. It is fairly nuanced. What has happened, the rules of the game have changed over the years. There has been capacity expansion, but largely through brownfields and through M&A. So we saw in NCLT, a lot of assets got acquired. SR Steel, Binani Cement, Bhushan Steel, all of those got acquired. A lot of the thermal power plants also getting sold. They're getting sold at a throwaway price, you know, 1.5 crore, 2 crores per megawatt kind of price. So whatever could be acquired and salvaged and turned around and all that, I also see that as capex, though it was not new greenfield capex. But so we saw that, a little bit of that happening. We are seeing quite a bit of brownfields happening where companies are expanding within their, in their existing operations. To get really greenfield capex that we are speaking about and to get the animal spirits going, I think the problem currently is a lot of capacity utilization is still between 70 to 75% in most industries. Historically, when I started my career in ICICI and all that, we used to see after 70% capacity utilization, people will start putting new capacity. Of course, there was slight, what I would call, misplaced incentives at that time, because an entrepreneur really made money by putting up a project, not by making the profit, and not by converting the project into a profitable project. So there was an incentive at that time to just put up projects. I mean, there were companies which were always looking for how much more capex I can do, because those were the misplaced incentives. So those incentives also gone away in a good way. I'm happy about it, because you should not put up a project so that the promoter makes his IRR before the project is over. But we need some animal spirits. I think there is a lot of animal spirits in the equity markets. There are no animal spirits in the credit market. So we are like an engine where the front wheels are moving, but the back wheels are not moving on the capex side. And that is because I think when I talk to a lot of corporates, a lot of entrepreneurs and all, they will now put capacity, very crudely if I say, after capacity utilization has crossed 80%, because there are two kinds of capex. One is ahead of the curve and one is after the curve. We earlier spoke, countries like China and all, they put up a lot of things ahead of the curve.
Yep.
India used to do that in airports and all that, but that is why a lot of the infra project also failed, because you are ahead of the curve. But it was okay, you are ahead of the curve, you got the cycle wrong, you can restructure, you can revive, and a lot of the projects, including things like SR Oil and SR Steel and all, were great companies, but they didn't get the capex cycle right for whatever reason, or there was over investment. So given that, people are not willing to take risks. So I think when I used to earlier look at 70, 75 as the start of the new capex cycle, I would now say 80. So when we hit 80% capacity utilization is where the capex cycle will start. We are not at 80 across the board in quite a few industries. And for 80 to happen, demand will have to grow. For demand to grow, we will have to create jobs. We'll have to create wages. We'll have to create earning jobs where there is spending power and all that. So I think we ultimately go back and we are stuck in that. It's not a problem that will stall India. India growth will not stall. But we'll be stuck in this between, I would say, a 6 to 7% growth. If you want to break out to 8-10% growth, we'll have to break out of that. And in this, what ultimately is required is what I call interconnected reforms. So we always look at reforms that ये reform हुआ, GST हुआ, IBC हुआ. But if you go back and see in, 30 years ago when we had the crisis in India, we did interconnected reforms.
1991.
After 1991, we had reforms on the investing side. All of us are born out of that because new mutual funds, the private sector mutual funds came out of that, the private sector banks came out of that, NSE came out of that, SEBI came out of that crisis. So the entire capital markets or the financial industry was born after that. But along with that, we also had, changes in FEMA, we had changes in your MRTP and other acts, on the entire industrial policy, the foreign trade policy, everything changed. So there was a lot of interconnected reforms, not just reforms in one area. And in India today, in order to break out of this, what I call the 6 to 7% growth, which is also not bad. I mean, you should feel relatively happy, but it's a glass half full. How do you go from half full to 3/4 full? I think we'll have to break the jobs, earnings, and the investment cycle, creating demand in the investment cycle. I think this particular budget tries to do that, but we need a lot more interconnected reforms. Unfortunately, reforms are easier to do in a crisis, as we have seen with organizations also. Our own organization, the best energy is when there is a crisis, but you should not need a crisis, and you should create a framework where you can create these interconnected reforms without a crisis.
Since you mentioned demand, there has been a lot of talk about consumption and this K-shaped recovery. To a certain point, it was highlighted in the election. Do you think there is a difference in consumption at the top end of India and in rural consumption? I know you say that there are multiple Indias within one India, so I think it's worth talking about.
But it is true. I think there is a K-shaped, so if you want to buy a Range Rover, there is a waiting period for 8 months or a year now. But if you want to buy a scooter, maybe it's available. So I think and it's across the board. Like affordable housing, we spoke about real estate, Trideep. Affordable housing is not doing as well as the upper end of the market is doing. I think Mumbai, Delhi, Gurgaon is going crazy. But the affordable housing is growing at a very, very normal, subdued pace. It's not growing crazy. So all these are indicators that there is a part of India, and that is why I say the jobs and the wages out there, they need to go up for them to spend. So there is a lack of consumption, and that is where we are seeing in staples, and we are seeing in FMCG and all that. While housing is doing well, stock market is doing well. So the upper end is actually doing well. The affluent and the mass affluent and the HNIs are all currently doing well. But I think the middle and the lower end are struggling on this. And that is why we are seeing it in the data. The unsecured loans have gone up.
Yep.
Who's borrowing? I don't think HNIs who are investing in the stock market are borrowing. 50,000 rupees or 100,000 rupees to buy a phone or buy a computer. But a lot of the middle class and the lower middle class are borrowing a lot. Household debt is going up. Consumption-oriented debt is going up. But even borrowing to pay interest is going up. So that is a problem we need to solve. If we don't solve that, the growth will be going closer to 6%. If we solve that, we'll be closer to 7%. If we create some structural answers, I think we have a good possibility of 8% to 10% growth also.
I wanted to switch gears and talk about AI, Rashesh. I'll travel to the smallest cities and constantly get the question, how will AI change things for businesses in India? I know you're a big learner. I know you've been doing some learning and studying on AI. So do you have a good answer?
I don't have a good answer. I have lots of questions. I have a huge amount of excitement. So I was in the US. I spent some time. I met about 40, 50 AI companies when I was there. It was actually one of the most energizing parts of my trip out there. And I see AI as what happened internet about 25 years ago. I think the same kind of, a lot of us are not able to understand. We are grappling. What we are calling AI today, half of that is only data scrubbing and data architecture, because the base of AI is data. It has other things also. It has LLM, large language models. It has a lot of other things, the algorithms and the what we call the million tree decision-making structures and all that goes into AI. But half of it is data. So all the companies I meet out here, I always say that if you want to even play the AI game, in any business you are in, get your data right. It will take another 2 years for a lot of companies in India to even get their data scrubbing data right, then go to algorithms and the LLM models and all that. So I think that is the current challenge. It's the same challenge in the US. So that there is how to do it, I don't know. I'm not an expert, but I have realized that data is going to be a good starting point. The other insight I got on AI when I was in the US was, if you look at the industrial revolution, it started with coal and steam.
Yeah.
It took almost 100 years after the industrial revolution for somebody to say, you know what, there's something called oil. So oil came into play almost 100 years after the industrial revolution, and oil changed the game. The game changer with automobiles and planes and all that was oil.
Yeah.
It was not steam only. So you could not have cars and planes and all with
Till you got oil.
You know, with only coal and steam. So it took them 100 years to say, oh my God, oil is going to turbocharge the industrial revolution, which has and created its own issues. I think AI is going to be what oil was for industrial revolution. AI is for the information revolution. We had computers, then we had internet, but AI is going to turbocharge the whole usage of this information the way oil did. And it's going to be very exciting. I think it's a 20-25 year journey for people to get AI right. It's not going to happen overnight. AI today is like a kid in high school who's very smart and has a lot of potential. He can play chess, or he or she can play chess very well and can recite all the stuff. But how to make that to use? It will have to grow into a good, responsible adult. And I think it will take 10 to 15 years. But I think for India and for a lot of Indian companies, it also has implications and risks for India. A lot of your coding, a lot of your global contact center management
Call centers, service.
Call centers and all, a lot of that is going to it's already happening. People are experimenting. In the next 4-5 years, your coding is going to get a lot more automated. So if you are a coder today, you are going to be like, spinning guy when industrial revolution happened. You will have to go from spinning to weaving and weaving to how to manage a power loom, or the spinning jenny from how to manage a loom is going to happen. So I think people will have to reorient themselves. They'll have to relearn a lot of things. But in the next 5 years, coding is going to change for sure. That is another insight we have. Contact center management is going to change for sure. It will get maybe stronger, better with AI based. So I think all this is going to be very exciting. I came back very energized. I learned just a little bit, but I think I got exposed to a lot more. And I'm telling everybody, if you want your business to become stronger, start grappling. It will take 5 years. It won't happen overnight. But it's like, about 25 years ago, you got your email ID and got your www or http://edelweissfinancial.com. Out there, we are at that stage.
So the last two questions I wanted to ask were specific to financial services. One is specific to our industry. We have seen a lot of headline about bankers complaining that SIPs are eating all their deposit growth. We in the mutual fund industry get very scared about it secretly because we think our tax is going to go up, which honestly kind of did. Do you see truth to this? Is it true, and will it continue?
It is true. It will continue because unfortunately the genie is out of the bottle because people have got risk capital. So actually, I think we need to see the structure of countries, all countries, not just India. There is a savings path, there is an investing part, and there is an entrepreneurial path. So what is happening in India, very strangely today, entrepreneurs are becoming investors and savers are becoming investors. I meet a lot of companies where 30 years ago, 20 years ago, companies would say, मेरा सबसे best investment is my own company. I'll put money in my company, I'll make 30, 40, 50% IRR on that. मैं तो अपने business में ही डालूंगा पैसे. Those guys are now saying, आपका AIF अच्छा है, आपका mutual fund अच्छा है, I will put some money. Part of it is because the kids don't want to really go through the entrepreneurial journey and all. So the entrepreneurial the entrepreneurial equity capital is also becoming investor capital. The savers' money is also becoming investors. Earlier, we had all three very compartmentalized. If you wanted to earn 5% to 8%, keep it in a bank deposit, FD, all of that. A lot of that is spilling over into the what I call the investing game. But along with that, the entrepreneurial capital is also coming, and that is also partly CapEx is not going up because the new generation wants to set up the family office now. Nobody wants to put a plant in MIDC anymore. And right?
It's very sexy to have a family office.
So I have a family office. In fact, I met an architect the other day. That architect specializes in setting up family offices. So now we have architects for family offices. And I asked him, he was along with me on the flight. So I asked him when we started chatting, I asked him, what is different? And he said, the family office, the interiors is very different. It's more softer colors. It's not corporate, but it's not home. So earlier you thought home was your a room in your home is your family office. But no, now they are proper family offices which are being designed keeping the ethos of the family office in mind. So that's where we are going. So I think it is that genie is out of the bottle. And part of the blame goes to you guys because you guys have given good returns. You guys have given good alpha. I mean, and when I say you guys, I say the whole mutual fund industry has done a fabulous job as really creating alpha. And at the same time, I think the return on being an entrepreneur, if you are an entrepreneur with only equity money, the returns are still there. So people are doing startups.
Yeah.
But if you want to be an entrepreneur and have to borrow money to put up a steel plant, which was happening 30 years ago, or a galvanizing plant or a coating plant, and all of those returns are not being seen because people are saying, I have equity, but I can't get equity return unless I can borrow money.
Yeah.
And you know what? I don't want to borrow money. I don't want to give my corporate guarantee, personal guarantee. I don't want my kids to be responsible if I get the cycle wrong or there is a strike in the factory.
So I'll just create a family office and give money to these guys.
So might as well just put money in mutual fund or in AIFs and we get there. So that is good for our industry, but that is economically bad because you need a balance between all three verticals.
Yeah.
You need deposits because they serve a different need. You need investing, risk-taking money, and you need entrepreneurs. And I always say entrepreneurs also take illiquidity risk because when you put up a plant, you are not liquid.
Yeah.
When you put up a steel plant or a road or a power plant, you're taking illiquidity risk. So what has happened is, I think the money going into banks is coming into mutual fund because you are giving price risk and the returns according to that, but you are still giving liquidity. We have to create an incentive for saying, if you're illiquid, you get even higher return, which AIFs are doing in part. The extra return AIFs make is mainly because of illiquidity. It's not because of the risk of loss of capital.
Yeah.
When an AIF is actually buying an operating road, an annuity road, there is no risk of loss, but there is illiquidity risk and you are getting a premium for illiquidity. So I think that we should create all three buckets and balance it. Government policy tries to do that. And over the period of time, government policy, market pendulum, because when everybody goes on one road, that road, Eastern Express Highway will get crowded. So at some point, people will say, Western Express khali hai, so let me make a U-turn and go there. And that is how rebalancing happens. It's very chaotic rebalancing. It's not a very happy rebalancing. If you can do it proactively through government policies and incentives, it's always a lot more structured without imbalances. But if it is chaotic, it creates issues like what happened in global financial crisis in US and all. I hope we don't have that. I hope we have this a little bit of subtle rebalancing. I'm also worried if bank deposits are not growing, if entrepreneurs are not investing, and only the investing AUMs are going up.
So my last question, Rashesh, is that you're talking to a bunch of, since you mentioned entrepreneurship, you're talking to a bunch of financial services entrepreneurs. Financial services entrepreneurship. I must confess, when our former group company Novama listed, Rashesh had a certain market cap that he thought it would list at, and I never told you this. I quite frankly thought you were crazy. And turns out that the current market cap is twice your expected number, so turns out I was wrong. But if in one or two lines you could summarize your learnings about creating value, the secret to creating value as a financial services entrepreneur in India.
So I think I always believe the holy grail for any entrepreneur or investor is this holy grail is what is value and how to create it. That's a holy grail. I mean, we all struggle with it. We all try in different ways. Whether you're an investor also, how do you really see value? You can see price every day, you can't see value every day. So I think, and we spoke earlier, value could be, the proxy for value could be momentum, can be this factor, that factor. And by the way, I found it a very fascinating conversation. So very excited that we are all at a stage where we're having this kind of complex, nuanced conversations also. So I think ultimately building businesses which really add value to the customers. And that is what you have to constantly ask your customers, that are we adding value? What is the value we are adding? Because the profit you can make, you can't make arbitrage profit. You can't make profit just because there is an entry tax for a customer, which maybe it was if there were only a mutual fund in India or 2 mutual funds in India. But with competition and all, we are ensuring that only if you add value to the customer. And in financial services, adding value to the customer is actually adding value to your employees, because employees are the product. Your product is your employees only. So I always said, hamare do bhagwan hote hain, employees and customers. As long as those bhagwans are, Vishnu and Shiva for us, all the other smaller gods will take care of your bankers and your investors and regulators are all aligned if these two are aligned, because these two are the main gods that you have in the pantheon that we have. And that is what I have learned. The other thing I have learned is you have to be patient. It takes time. Everything takes time. So you gave the example on the Nuvama business. We started the business about 20 years ago, and then it got added and evolved, and then we acquired Anagram and all that. But every 3 or 4 years, we were pulling our hair out and saying, how do we make this business work? How do we add value to customers? How do we, get unit economics right? How do we get all that right? And you just had to say, let's plug away. I think Edelweiss Mutual Fund is another classic example. We have 8 businesses. So for each 8 one of them, I've got some 3 or 4 stories to tell, but I'm not going to tell all of them. But Edelweiss Mutual Fund, we started in 2008.
Yeah.
By 2016, we were around 1,000 crores AUM.
Yep.
So the first 8 years, we effectively were not getting anything done. We were only but we kept on investing in the business, in the platform, looking at, people, all of that. And then 2016 to now, from 1,000 crore AUM to
almost 1.5 crores.
Another 8 years. So it takes time. And the curve is never a straight line. We all are, I'm an MBA. So we open an Excel sheet, and when we make a plan, we just say, 18% growth per annum. But whether it's equity markets, whether it's anything else, usually the curve is like this. It's like a plane. You will taxi, and somewhere the customer who is the air traffic controller for you will at some point say, okay, now you can take off. But you have to have the patience to keep on taxiing and constantly looking at parameters, saying, okay, are we getting this right? Are we getting that right? So the Nuvama example was classic on that. Edelweiss Mutual Fund is classic, or all asset management business. And it's not that in all the 8 businesses we have got it right. There are a couple of businesses, even now, we are pulling our hair out and saying, how do we get this right? How do we get co-lending right? How do we get our ROE right? How do we really understand what the customer needs are and convert into something we can offer in a cost-effective manner and make the unit economics work?
Correct.
So all these are the real challenges of India. But if you just be at it and you have good culture and people, I think it gets solved. But you need both culture and people. Only people is not enough. Only culture is not enough. You have to have this culture of saying, plug away. Listen to customers. Go back to the drawing board and get it done. But eventually, not only in our business, I've seen a lot of other businesses, it ultimately works out.
There's a happy ending. Okay.
Yeah, as they say in India, it always ends well. If it has not ended well, it's not the end yet.
So since we are coming to the end, I do this. I channel my inner coffee with Karan, and I do a rapid fire with Rashesh. I call it Rum with Radhika. I'm assuming the sales team has a hamper. So I got some new questions, Rashesh, that I haven't asked you before. And they're clever and they're creative. So
usually very slow, and I'm getting slower as I'm aging.
And I'm pushing you to get rapid and with fire. Okay. So if you were an advertising guy, could you give India a tagline, like a tagline for India? An advertising tagline for India.
Compounding story.
Compounding story. Okay. Do you have a song that you think describes equity markets today?
I think the closest one would come is the one you guys used to like a lot, Apna Time Aayega.
Apna time aayega.
Because actually, aaya nahi hai. We are still $4 trillion, $3,000 per capita. I think the next 10 to 20, I wish I was today 40 years old and had at least another 20 years where you could enjoy this India. And I think this will happen in India.
Okay, so if I gave you 100 crores, not more than that, because I don't have that much money, what business, okay, maybe. What business would you start today?
I would start an AI company.
You would start an AI company with 100 crores.
I would start an AI company and with 100 crore, but make sure I'm managing my cost very well and ensure that with 100 crores, I should be able to last for 8-10 years. If I need more, then I have to go out and raise capital. I always say a good entrepreneur and a good CEO not only has to run a business, but has to raise capital from time to time, whether it's bankers, equity investors. You are an incomplete CEO unless you can raise equity capital and capital from your stakeholders.
Okay. A business created in the last 10, 15 years that you admire in India?
I think Swiggy and Zomato are the two businesses I think has truly, they identified a niche and really created something. They also made the unit economics work. It's been, I think, unpleasant at times where they had to fight between various stakeholders, but I admire them. I think they have made it work.
Okay. I'm giving you a lot of money today. If I give you 10 crores to invest.
But I must also add, even Edelweiss Mutual Fund I admire.
Thank you.
In the last 15 years.
Thank you. So since you admire Edelweiss Mutual Fund, I'm going to give you 10 crores. Where would you park it in? And Edelweiss Mutual Fund has a lot of products. So you can choose active, passive, large cap, factor, whatever you want. Where would you invest 10 crores in Edelweiss Mutual Fund?
See, I think investing is a very, very individual specific. I'm at that stage in my life, I'm happy with index returns. So I would just invest in the index fund. But if I was slightly younger or wanted to be more active and wanted to take a little bit more risk, I would invest in the SME fund. But obviously it has gone through the roof and all that. But I ultimately believe in capital allocation, in diversification. In the short-term basis, I would also invest in the gilt fund because I think interest rates, if they come down, a 30-year gilt is also going to do well.
Okay. So I'm just going to ask you for a couple of quick pieces of advice for people. So one piece of advice for the mutual fund industry?
Constantly innovate.
Constantly innovate.
I think the customer needs are changing and they are evolving. And I think innovation is the only way because ultimately a mutual fund is a mutual fund. It's hard to differentiate. So the problem we have in the mutual fund industry is how do you differentiate in a commoditized, because there are rules on cost and pricing and all that. So within that, you have to, only way to differentiate is innovate.
Okay, one piece of advice for SEBI. One piece of advice for SEBI. It's not a recorded
I would not take the risk. They have a very difficult job. They have a very difficult job. But I think the only thing every regulator has to do is to balance growth and investor protection at the same time. It's not an easy job because there are constant pressures on both sides because with innovation comes risk of a wrong product being sold to a wrong customer. So my only advice, if at all you call it advice, it would be request more than that, is to balance growth and investor protection.
Nicely done. Since you like the idea of being in your 40s and we're sick of asking for advice for 20-year-olds since they don't listen. One piece of advice to your 40-year-old self. I assume I'm in my 40s, some of us are in our 40s.
You'll find it strange, but I think the advice would be believing in India, trust India, believe in retail financial services. I think we made investments, but I wish I could go back and make more aggressive investment. We made it more tentatively. So I think the retail financial services India, the India opportunity also, because every 3-4 years, I must say, there is a question mark on the India story.
Yeah.
That happens to everybody, no matter how hardcore optimist you are, no matter how bullish you are, India will test your faith. Every 3-4 years, kuch hoega, it will taste, there'll be a taper tantrum, there'll be something else that will happen. And I think it is at those times that you should revisit your faith in the India story.
Okay, so some last 4 fun questions. What do you use ChatGPT for?
When I turned 60th, I had to give a speech at the birthday party. I think, and that is what I've learned. I mean, the other thing I've learned is actually there is abundance. So there was about a few years ago when I was 40 years old, I felt I don't have enough capital, I don't have enough time, I don't have enough opportunities, I don't have enough people. Ye nahi hai, wo nahi hai. There was a FOMO. In the last 20 years, as I've gotten older, I've learned that actually बहुत time hai, बहुत opportunity hai, बहुत capital hai, बहुत log hai. Just be patient at that. And that is a sense of abundance that you have, which allows you to be not only a great businessman, but also a good human being.
This is my last question. I've never asked you this, and don't kill me for this. What's the secret to a happy marriage?
I think it's different for the husband and for the wife. But I think ultimately, idea is everybody grows and you have to grow, but it's not just happy marriage, it's any relationship. It's communication, communication, and communication. I think as long as you're communicating, even good things, bad things, I think there is hope. Once you stop communicating, I've seen in organizations also, whenever any businesses have issues or people have issues, the interpersonal issues all the time, one thing I force people is to communicate. I and my co-founder, Venkat, for 28 years, we have been screaming and shouting at each other all the time. But we have always said, as long as we can get in the room and communicate with each other, it becomes easier. The moment you stop speaking and communicating, then the breakdown of trust and politics and everything enters. I think it's the same for the marriage. Communication is the hardest thing to do, but it should also be the easiest thing to do.
Fantastic. Rashesh, thank you. I think
Thank you.
Thank you very much to all of you. I think we end right here. I will hand it over to Varun Sanan. I know, Varun, we have time to take some questions. So let's take a couple of questions if we can pass the mics around.
And it can also be on investing because
anybody can answer questions.
I've always spoken on investing part of it.
We've covered everything from equity markets to happy marriage. So we've had a complete evening.
Hello, sir. I'm Dhananjay Kunte. You talked about giving interconnected